Let's talk about the single most powerful tool available to anyone who wants to build wealth. It's a concept that's been around for centuries, quietly working its magic behind the scenes, and it's far more accessible than most people realize. We're not talking about complex trading strategies or risky investments. This is a fundamental principle that, when understood and applied correctly, can transform your financial future, regardless of your current income or background. It's the magic of compound interest. And it's not just for bankers, financial gurus, or the ultra-rich. This isn't some exclusive club with a high barrier to entry. Compound interest is a democratic force in the world of finance, available to anyone willing to learn and put it to work. It doesn't discriminate based on your profession, your education, or the size of your initial investment. In fact, anyone can use it to get rich over time, even starting small. The beauty of compound interest lies in its ability to turn modest beginnings into substantial wealth over the long haul. It's about consistently nurturing your savings, allowing them to grow exponentially, and harnessing the power of time to work in your favor. Think of it as a snowball gathering momentum as it rolls down a hill. Initially, the snowball is small, but as it rolls, it picks up more snow, becoming larger and faster. Similarly, your money earns interest, then that interest earns more interest, and so on, creating a powerful cycle of growth. This is the essence of compounding, earning returns on your returns. To truly appreciate the power of compounding, let's compare it to simple interest. With simple interest, you only earn on your original amount. The interest you earn each period remains constant, resulting in a linear growth pattern. But with compound interest, your earnings grow on themselves. The interest you earn is added to your principal, and in the next period, you earn interest on the new, larger amount. This creates an exponential growth curve, where your wealth accelerates over time. Over years, even decades, this creates a cycle of accelerating growth. The longer your money compounds, the more dramatic the results become. It's like planting a seed and watching it grow into a mighty tree, providing shade and bearing fruit for years to come. It's the key to turning modest savings into a fortune. Small, consistent contributions combined with the magic of compounding can lead to remarkable wealth accumulation over time. That's why Einstein, one of the greatest minds in history, called it the eighth wonder of the world. He recognized the profound impact of compounding and its ability to create wealth on a scale that seems almost magical. He famously said, "He who understands it earns it, he who doesn't pays it." In other words, those who grasp the power of compound interest are the ones who will reap its rewards, while those who remain ignorant of it will likely miss out on a significant opportunity to build wealth. The best part is that compound interest works quietly in the background, diligently growing your wealth, even when you're not actively working on it. It's like having a silent partner that's constantly working to grow your money while you sleep, allowing you to build wealth passively and achieve your financial goals with greater ease. Now, it's important to understand that compound interest is not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. It's not about overnight riches or instant gratification, but a get-rich-surely strategy, a reliable and proven method for building lasting wealth over time. Mastering this concept, understanding how it works and putting it into practice, is the first and most crucial step on your journey to financial freedom. It's the foundation upon which you can build a secure and prosperous future. Let's demystify the magic of compounding with some real numbers. It might seem a little daunting at first, but trust me, it's easier than you think. We're going to break down the core principles and show you how even small amounts can grow into something substantial over time. Forget complex formulas for now. We'll focus on understanding the underlying concept. Let's say you decide to invest £1,000. This is your initial investment, the seed money that will start the whole process. We'll assume a hypothetical scenario where you're getting a return of 10% per year. This is a simplified example, of course, but it serves to illustrate the power of compounding effectively. After year one, you've earned £100 in interest. That means you now have a total of £1,100. Simple enough, right? This is where the magic starts to happen. That initial £100 is now part of your principal, and it will also start earning interest. In year two, you're not just earning 10% on the original £1,000, you're earning 10% on £1,100. That's £110 in interest, bringing your total to £1,210. Notice how the interest earned is slightly higher than the previous year? That's the compounding effect in action. Each year, the amount of interest you earn grows. And this is the key to understanding compounding. It's not just about earning interest, it's about earning interest on your interest. This creates an accelerating effect that can significantly boost your returns over time. This happens because your money is essentially earning on itself. The interest you accumulate becomes part of the principal, and then that larger principal earns even more interest. It's a virtuous cycle that fuels exponential growth. Over the course of decades, this snowball effect becomes truly massive. What starts as a small snowball rolling down a hill gradually accumulates more and more snow, growing larger and larger as it goes. The same principle applies to your investments. There are 4 key ingredients that contribute to this compounding effect. Understanding these will help you maximize your investment potential. The first is your starting amount, the initial capital you invest. The larger your initial investment, the bigger the base upon which compounding can work its magic. The second is the interest rate, the percentage return you earn on your investment. A higher interest rate will obviously lead to faster growth. The third is time, the duration over which your money compounds. The longer you allow your money to grow, the more significant the compounding effect becomes. And finally, any extra contributions you make along the way will further accelerate the growth. The longer you leave your money untouched, allowing it to grow and compound, the bigger your snowball gets. Time is your greatest ally when it comes to compounding. Think of it like planting a tree. You start with a small seed representing your initial investment. The more you nurture it, providing it with water and sunlight, the stronger and healthier it becomes. This represents the consistent effort you put into your investments, and the longer you wait, allowing it to grow undisturbed, the bigger and more majestic it becomes. This is the power of time and compounding. The key is to resist the temptation to dig it up early. Avoid making impulsive decisions that could disrupt the growth process. Instead, let compounding do the heavy lifting. Trust the process and allow your investments to grow organically over time. Plant your seed, nurture it with consistent effort, and then patiently wait as compounding transforms it into something truly remarkable. The secret ingredient to compounding is time. Start early. Amy invests £100/month at 25. Ben waits until 35. Both get 8% returns and retire at 65. Amy ends up with over £349,000, Ben, just £150,000. Amy's 10-year head start more than doubles her final pot, even though she only invested a bit more. Early years build the foundation for future growth. Ben can never catch up. Even small amounts invested young can outgrow larger sums invested later. If you're young, your biggest asset is time. Don't wait. Start with whatever you can, even £20 a month. Starting early is your financial superpower. So how do you actually make the magic of compounding work for you in your own financial life? It's not about finding a secret formula or some hidden loophole. It's about understanding the core principles and applying them consistently over time. We're talking about building a solid foundation for your financial future, brick by brick. Consistency. This is the bedrock of compounding. It's about making regular contributions no matter how small they may seem at first. Think of it like planting a seed. You wouldn't expect a tree to grow overnight, would you? And automation. Set up an automatic transfer. This is where technology becomes your best friend. To your investment account right after payday, pay yourself first. Treat your future self like you would treat any other important bill. Prioritize your investments. Always reinvest your earnings. Don't let those dividends or interest payments sit idle. Let every penny keep working for you. Reinvesting allows you to buy more shares or assets, which in turn generate even more earnings. It's a snowball effect. Higher returns grow your money faster, but remember, there's always a trade-off. But come with more risk, so it's important to understand your own risk tolerance and invest accordingly. Stocks usually beat savings accounts over time. While savings accounts offer safety and liquidity, they often struggle to keep pace with inflation. Stocks, on the other hand, have the potential for much higher growth, especially over longer periods. Don't panic during downturns. Market fluctuations are a normal part of investing. Stay invested for the long haul. Compounding works best over extended periods, so resist the urge to jump in and out of the market based on short-term news. Avoid checking your portfolio daily. It can lead to emotional decision-making. Think in decades, not days. Investing is a marathon, not a sprint. Regular investing also means you buy more when prices are low, which is a strategy known as dollar-cost averaging. Less when high. This smooths out the ride. It helps to reduce the impact of market volatility on your overall returns. Make it automatic, to remove the temptation to skip contributions during tough times. Stay patient. even when the market seems to be going nowhere. And let time do its thing. Time is your greatest ally when it comes to compounding. Compounding rewards those who stick with it. It's a testament to the power of discipline and long-term thinking. Set it, forget it, and trust the process. And watch your wealth grow. It's a journey, not a destination, and the rewards are well worth the effort. Compound interest can work against you if you're in debt. High-interest debts like credit cards use compounding to grow what you owe, fast, paying only the minimum traps you for years, costing thousands extra. Priority 1, pay off high-interest debt before investing. It's like getting a guaranteed return, nothing beats that. Use the debt avalanche method, pay off the highest interest first, then move down the list. Once debt is gone, channel those payments into investments, and let compounding work for you. Understand compound interest, respect its power, and use it to build, not destroy, your financial future.